Yes, well, I don't need to do any introductions now. That's a very good. I mean, I know just to start off, Avinash, I know you wanted to sort of respond to some comments that were put up in the previous session.
I thought we had a really interesting discussion just now, and it's worth talking a bit about that. I have a slightly different perspective. There clearly is a premium, and that premium is blocking the flow of capital to emerging markets in general, Africa in particular. And this is a real problem for climate because, you know, the developing world needs $2.4 trillion of investment per year. About 1 trillion of that, at least, probably more, has to come from overseas. And that's about twice the amount that's coming. So the fact it's not coming is a problem, and this premium is a big factor. But I think, as a finance person, I think the premium lies in something else. It's not, I mean, there is bias, but it's something else. And it's about the way the international financial system works. So Europe as a whole, when we sit here in Europe, debt to GDP ratios are pretty high globally. There are many, many developing countries that have lower debt to GDP ratios than Europe as a whole, and many European countries. Many of them. And they pay a lot more for their debt. Why is that? They don't have an ECB. Because the international financial system is broken down into reserve currency issuers and people who import reserve currencies. People who export safe assets and people who import safe assets. Now, when you're an exporter of safe assets, you own reserve currencies, and there's a crisis, money is flooding into your reserve currency, which allows you to respond to the crisis by lowering interest rates, by expanding fiscal policy. You can act counter-cyclically, and you can reduce the crisis. Now imagine yourself in an African country, you're in a financial crisis globally, money is fleeing your country. You're going to respond by raising interest rates, by cutting fiscal policy. So in the countries that are importers of safe assets, their policy response makes the crisis worse. In the countries that are exporters of safe assets and have reserve currencies, their policies make the crisis less worse. This difference investors observe. And investors say, I don't want to be in the middle of that. And that's why they charge a premium. Now, economists will stop there. But the thing is, why do certain countries export reserve currencies and others don't? That's by design. The international financial system, our auditing system, our risk management system, our bank regulation defines what is a safe asset. They define the safe asset as US dollars and euros. Not at all clear they are safe assets. I mean, most governments define their own government bonds as safe assets in the structure of the banking system and banking regulation. Many of those countries are not safe, but it's defined as safe. So we need to find a way of either redefining safety, and Africa maybe can come together as a exporter of many things that are hugely valuable, intrinsically valuable. Maybe they can create a safe asset that is recognized in Africa and elsewhere. Or we could do something that I've just been involved in, which is, imagine there's a crisis and you've invested in a renewable energy project, and the multilateral development banks who have AAA rated status, and so money's flowing to their assets in the capital markets. Imagine that they offer to lend the US dollars at their borrowing cost, at their AAA borrowing cost, in the middle of a crisis over the long term. What you're then doing is taking the AAA status and you're casting it as a cordon around renewable energy assets in developing countries. And that's what we've just done with it. We've launched a product, the IDB and Brazil launched a product in the end of March. IDB is backing it with $5.4 billion, and it's about breaking that premium by saying that in a crisis, we'll be there. And that should make investors more confident And we want to spread that model across the world, working with the African Development Bank, the Asian Development Bank, and others. So that's the way, I think, of dealing with the fundamental problem, which is the imbalance, the asymmetry of the international financial system.
And has your experience of that proven that, obviously it's still early days, I suppose, of the project, you're still developing it, but in the sense of actually application of it, have you found that it is inherently scalable and also impactful? Is that something that's already become clear by that?
That's a great question, because the Brazilian government came to us with the idea and said, we want to do this. But to make it start off, I'm a big believer in the 80-20% rule. To start it off, because perfection is the enemy of the good, we developed something that's very particular to Brazil. And what we're now doing is trying to work with the G20 on developing a more scalable, standardized version where any multilateral development bank can plug into it and basically define what it is that they do and how risks are managed elsewhere. A lot of, I benefit as a finance person by people believing finance is magic. It's not. But finance can rearrange risks and therefore have them better managed. And what we're doing with our hub is basically rearranging risks. We're saying the projects can manage inflation risk by raising their prices. Governments can manage macroeconomic risk by having stable macro systems. The developed AAA-rated development banks can manage global financial risk. And by separating out the risk that way, we can dramatically reduce hedging costs.
That's fascinating, yeah. I mean, if we sort of go back, back in 2022, you were involved in the Bridgetown initiative, weren't you? And you worked alongside with the Barbadian Prime Minister, Mia Mottley. It's really fascinating. Obviously, proposed a three-step, essentially, a plan to sort of reform the global financial sort of architecture in the face of global crises, social, obviously, environmental. It's a fascinating and really focused document. So if any of you haven't read it already, please do seek it out and have a look at it afterwards. But one of the things that jumped out at me, especially with thinking of obviously the audience here, was it mentions that major debt market issuers should help normalize, was the phrase, a natural disaster and pandemic clause, these so-called climate resilient debt clauses, or CRDCs, in debt instruments in order to absorb shocks better, and that they should do it even if they're not going to use it. Could you sort of unpack that and sort of give a call to action, I suppose?
So the Prime Minister of Barbados invited a whole set of people down to Bridgetown, and who says no to that? And they spent about 2 days discussing, and they said at the end of the day, pointed at me and said, okay, you write up what we've discussed, and we'll meet for dinner in 2 hours' time. So I'm sitting at my desk, completely stuck, because as you can imagine, all of these discussions, people are wide-ranging, and people raise lots of problems and few solutions. And I remember that the most impactful declaration ever done by policymakers, and some of you will remember, is October 2008. It's after Lehman Brothers. The shortest G7 statement comes out. It's got 5 points on it. And it says, we are going to act. We are going to be lenders. We are coming in. And I thought, oh, okay, I'll base my Bridgetown declaration on 5 things. 5 things that will move the needle. And one of them was the fact that climate change has become an uninsurable event. Now, many people in capital markets don't like me to say that, but it's the reality. Insurable events are things you can spread over time because they're steady, things you can spread across other assets because they're uncorrelated, things you can pool together because you're uncertain and it's in a bunch of other uncertain things. Climate change is certain, increasing loss, increasing frequency, increasing correlation. So we were thinking, well, what do you do about this? So liquidity is what countries need in a crisis. So we found that there was these, they were initially called hurricane clauses, natural disaster clauses, and we put them in our bonds when we restructured our debt. So we suddenly became the biggest issuer of hurricane clauses. And it's always useful when you're trying to put forward something to be credible. So we went around the world saying, we're the largest issuer of natural disaster clauses in our bonds, and they're hugely beneficial. And in these clauses, they're NPV neutral. So if you are a lender, it's NPV neutral. Yes, the interest and principal payment is deferred for 2 years, but it's added back on with the equivalent interest rate. And from a country's perspective, they get liquidity that no other instrument gives them. No other instrument. In our case, 17% of GDP in the middle of a crisis. We felt that a big thing is we needed to basically socialize, normalize these, and we've worked with ICMA, and ICMA produced 2 years ago, at the same time as Bridgetown, a model natural disaster clause. And we really want the private sector to be adopting this. So when we pushed Bridgetown, Bridgetown became a very exciting idea. All the multilateral development banks have come in and said, oh, we'll put them in our bonds. When we put them in our loans when we lend to governments. But we never thought it was going to be about multilateral development banks, because the largest owners of loans to developing countries are not the MDBs or governments, it's the private sector. So we need the private sector, we need countries to be able to issue government bonds with these clauses in them, and private creditors to say, yeah, I don't mind having these. In the same way that we now issue CACs, collective action clauses, again based on an ICMA model, based CAC, and so we want the same thing to happen. And we'd love to work with people here in this room and elsewhere on how do we make these things more acceptable. They're NPV neutral, and how do we make them people more comfortable? Because we're living in a world of greater shocks.
That's really fascinating, yeah. I mean, another thing, obviously, that ICMA has been very sort of like leadership, and is with regard to, obviously, sustainable bonds, labeled sustainable bonds. Now, I know you're a bit cool on the sort of the additive value of use of proceeds bonds, such as green and blue bonds, when it comes to sort of emerging markets and closing that financing gap. But you have a much more sort of optimistic view about SLBs, sustainability linked bonds, and what they could potentially generate or prove as a tool for the overall sort of market. I mean, could you unpack what excites you about that structure? Yeah,
I mean, just very simply, I look at the green bond market, and it's great that such a thing exists, but the yield on a green bond and a yield on a non-green bond are very, very similar. So you begin to wonder, what are you actually doing? Debt swaps, Barbados and the Inter-American Development Bank are pioneers in debt swaps. We have some of the biggest and the earliest debt swaps, but they're very particular. A debt swap only works where you've got a kind of an amount of your debt that's very high yielding, but you don't have a lot of high yielding debt otherwise, right? Which is an unusual situation, because the point is, if you've got high-yielding debt everywhere, you're as an issuer, you need to restructure your debt, as opposed to just swap it into other things. So we think there's a role for debt swaps, but it's not as big as people think it is. But what we just launched at the Inter-American Development Bank is a type of reward for results in sustainability. So we'll issue a bond, say $100 million, a loan, $100 million for a seawall, at our rate of borrowing, so today about 4 or 5%, add a bit of a spread to the country. When an independent assessor has said that we have now, the seawall has made the community behind it much more resilient, then we will put in some of our capital to lower the interest rate by 0.5%, because that's all we can afford, because it's already at very low interest rates. But we then go to donors and philanthropists and others and said, well, can you put in 0.5% as well? And we're hoping then to be able to take the yield on those bonds, the cost of servicing, down from 5% to 2% or 1%. So that allows the borrowing country to do a lot more sustainability. Because basically we need about $300 billion per year in the developing world, $300 billion per year of building resilience per year. And they don't have the capacity to borrow that amount if they're doing that at commercial rates. So if we can lower the debt servicing, then they could borrow twice the amount, 3 times the amount, and make themselves resilient to this changing climate.
So are these sort of words, again, a sort of call to action, I suppose, to people out in the audience here, to sort of, what can they do to sort of help support that development?
Well, those people who are interested in impact investing might want to join with us in co-investing in those instruments. and help us find those people prepared to put the grants back on the basis of a response to resilience, and help to socialize and normalize these instruments.
That's really fascinating. We're nearly out of time, or is that overtime? I can't quite tell. But just a sort of a final question is sort of around about, obviously so far, certainly in the sustainable bond market, it's been much more, the focus has been on climate mitigation projects has been the main thing. But they started to turn towards the climate adaptation topic as well. I mean, what do you think the possibilities and the prospects are for doing that? Is that something that we should be doing more of, or is it maybe a dead end at this stage?
Well, definitely for sustainability bonds for governments, we need that on adaptation. Adaptation is the big problem for developing countries. Mitigation is the big problem for the planet. But mitigation, so reducing greenhouse gas emissions, can be done in a way that generates profits and revenues. Whether it's solar farms, hydroelectric, wind turbines, they generate revenues. We need the private sector involved in those instruments. But for the governments, they need new ways of building resilience cheaply. That's why we need the sustainability bonds.
Well, that's fascinating. Embarrassingly, I've discovered that that is, in fact, going overtime. So apologies, but thanks ever so much, Avinash. That was a really fascinating discussion and really interesting points, so thank you.
Thank you.